Hello and welcome to the Certified Equity Professional Exam Overview webinar for Level 1. This segment of the webinar is focusing on taxation. We've provided this webinar to assist in your exam preparation process. The Level 1 webinar is being conducted by Andrea Kagan, who is a Senior Project Manager for Stock Administration at NVIDIA. She's also a member of our curriculum committee on the tax panel that helps determine the tax curriculum. So on Level 1, a third of the test is devoted to tax topics. Your test will have 110 questions. 100 of those questions are scored. 10 of them are what we call experimental items that we use to determine statistics for items that we've never used before. Your passing score does not take those items into account, but as a result, you may see a few more than 33 tax items on the exam. And then the list on this slide is just hitting some of the high-level topics that are covered in tax at Level 1, and you're going to get a lot more about those as Andrea gets going. And on that note, I will hand it off to you, Andrea.
Thanks, Pam. Let's start by talking about how people earn money with respect to equity compensation. There are two components, compensation income and capital gain or loss. Compensation income is similar to wages or ordinary income. An example of compensation income is when you exercise a non-qualified stock option. The spread between, or the difference between fair market value at exercise and the exercise price is compensation income. The company has an obligation to report compensation income and, where applicable, to withhold tax on that income. When the company reports compensation, it's generally entitled to a tax deduction for the same amount that was reported as compensation income. The second piece is capital gains and losses, which refer to the profit or value received from the sale of an asset. As it applies to our discussion, capital gains and losses would apply to amounts outside the ordinary income amounts reportable or reported by the company. For example, when you sell the shares that you exercise for that non-qualified stock option in our earlier example, you will have a capital gain or a capital loss. Capital gains and losses can be short-term or long-term. Either short-term if the shares are held for less than a year, or long-term if the shares are held greater than 1 year. The short-term capital gains rates are the same as ordinary income rates, but the long-term capital gain rates are lower, only 15 or 20%, depending on the person's income level. The company does not receive a tax deduction for capital gains or losses attributable to employee transactions, and the company has no reporting or withholding obligations with respect to those amounts. As you earn income, you pay taxes generally through payroll deductions, meaning the company will withhold the taxes. If the withholding is not enough, or if there is no withholding, as in the case of capital gains, then the individual may need to make estimated tax payments during the year. What types of taxes are subject to withholding by the employer? We're all familiar with income taxes, both at the federal and state levels. As we mentioned earlier, the spread or gain on non-qualified stock option exercises is treated as supplemental wages for tax withholding purposes. Supplemental wages of $1 million or less per year are subject to a different rate than supplemental wages of greater than $1 million per year. The rate for up to $1 million is 22%, and the rate for the amounts of supplemental wages over $1 million is 37%. State income tax is different depending on state law, and some states do not have an income tax at all. FICA consists of U.S. Social Security taxes and Medicare taxes. There is an annual cap on Social Security tax, but not on Medicare, which goes up after a certain income level. SDI, which is state disability insurance, also varies by state. Many states do not collect state disability from the employees, but for some that do, SDI is also subject to an annual maximum or wage limit. FUTA taxes are unemployment taxes paid by the employer. The employer must also match, the employer must pay the same amount of Social Security and Medicare taxes paid by the employee. Taking a look at incentive stock options, or ISOs, we need to be familiar with Code Section 422 because that is what governs them. In order to enjoy the favorable tax rules applicable to ISOs, they must comply with all the requirements of Internal Revenue Code IRC Section 422. In general, there is no company tax withholding on exercise of an ISO, and companies receive a tax deduction for ISOs that are not held for the required holding period, or the other way to say that is the companies receive a tax deduction for ISOs that are disqualified, that are disposed of in a disqualifying disposition. Let's look at the next few slides for some specifics. ISOs have stringent holding requirements in order to benefit from the preferential tax treatment. The ISOs must be held 2 years from the date of grant and 1 year from the date of exercise. If both of these holding periods are not met, then the individual will lose the preferential tax treatment associated with that ISO. If those holding periods are not met, that's called a disqualifying disposition. If you do meet the holding requirements, then that is what's called a qualifying disposition. And we have examples on future slides. Unlike non-qualified stock options, incentive stock options have very strict requirements. The plan itself can allow for the grant of other kinds of equity and grants to non-employees, but must specify the maximum number of shares that can be granted as ISOs, and must ensure that ISOs are granted only to eligible people. The plan must also be approved by shareholders to satisfy the Internal Revenue Tax Code. ISOs can be awarded to employees and only employees. Other requirements for ISOs include they must have a grant price of no less than 100% of fair market value on the date of grant. And if an employee is a 10% owner of the company, then the ISO must be granted at 110% of the fair market value on the date of grant. For the employees that are a 10% owner, the term of the option can only be 5 years, whereas for other employees, the term of the ISO can be no longer than 10 years. ISOs are also non-transferable, and there's also a $100,000 rule or limitation, which says that no more than $100,000 worth of incentive stock options can become exercisable per year. So if you grant an ISO on a 1-year cliff, then a monthly vesting schedule after, and it's granting on October 1st, nothing is exercisable in the year of grant, but 1 year's worth of vesting plus another 3 months worth is all counted the next year in the 100,000 limit. We have some additional examples on how to calculate the 100,000 limit. ISOs, as we mentioned, can be granted only to an employee, and you must be an employee within 3 months of exercise. That is, if you leave the company, you will only have 3 months to exercise the option as an incentive stock option. If there are special circumstances, such as the employee being disabled, there's an extension of up to 12 months to be able to exercise the ISO, and the rule does not apply in the case of death. We'll talk about all of these more later. The consulting agreement alternative provides the company with continuing access to the former employee's knowledge base and may also be used to help negotiate a non-compete agreement or similar post-termination settlement. However, the technical tax and accounting analysis may be unattractive to both parties, particularly if the option is an ISO. For tax purposes, the code requires that ISOs may be granted only to employees and may be exercised only for a period of up to 3 months after termination of employment, as we stated previously, unless there are special circumstances. For ISOs, the estate can have until the end of the option's term to exercise, although companies can set shorter limits. For example, the XYZ company sample plan document in your binder limits post-death exercise to 1 year. If options are exercised prior to death, the transfer of the shares after the exercise is not a disposition, and the ISO holding periods do not apply. Moving to taxation of ISOs, there is no tax consequence to the employee, either at the time of grant or the time of exercise. However, the spread at the time of the exercise of an ISO is considered a preference item that is subject to the alternative minimum tax AMT requirements. So regular tax is not due at exercise, but at the end of that year when your 1040 is being completed, you need to also fill out an AMT schedule to see if you will owe some special alternative tax unless you sell the shares before the end of that calendar year. The good part of this scenario is that if you hold the ISO for the required holding period that we discussed earlier, 2 years from the date of grant and 1 year from the purchase date, then when you sell, you've got a qualifying disposition and long-term gain. And you can potentially offset that AMT if there was any that was paid. If you don't hold the exercise ISO for the required holding periods, then the sale will be disqualifying and will disqualify the ISO from the long-term capital gains treatment. In this case, the ISO will end up looking very similar to a non-qualified stock option. And you'll have to pay ordinary income tax on the spread. As for the company, since there's no tax consequence at the time of exercise, there's no obligation for the company to operate withholding. At the date of sale, if the sale constitutes a disqualifying disposition, the company is required to report ordinary income on the W-2, but is not required to withhold tax. If the sale is a qualifying disposition, the company is not required to report. The company can take a tax deduction only for disqualifying disposition ordinary income amounts that the company has reported on the W-2. So we talked about the 100,000 limit, so let's talk about how that's calculated. $100,000 is divided by fair market value on the grant date to arrive at the total number of shares that may be granted and become exercisable in that year. It's important to note that the amount used is the grant date fair market value, regardless of whether or not that's the exercise price. In other words, the exercise price can be higher than the fair market value, but fair market value is still used for this calculation. Let's say fair market value on the grant date was $10. The $100,000 limit divided by 10 is 10,000 shares. If you were granting shares that would all be exercisable in that calendar year, and you were only granting 5,000 shares, then you're under the limit of the 10,000, and you have some leeway for granting more ISOs that vest in that year. Any shares granted in excess of this 100,000 limit are treated as non-qualified stock options. You can do the same calculation reflecting dollars instead of shares, and this is better when dealing with overlapping awards. So let's look at some examples. In this example, the shares vest 2,500 shares over 4 years. The total granted was 10,000. Since they were granted in 2012 but vest annually, they were granted in 2015 but vest annually, there's no calculation for 2015. Starting in 2016, the first 2,500 shares vest and the value is $37,500 based on the grant date fair market value of 15. $15 per share times 2,500 shares vesting is $37,500. This leaves $62,500 of the remaining $100,000 limit remaining for the year. Since there are no more shares that will vest that year, there is no issue. Each year in this example is the same with no leftovers. But it is rare that you would only have one award with one tranche vesting in a year. So let's now take a look at what happens if we add another award to this scenario. On May 15th, 2016, the following year, the same employee receives a second ISO grant for 1,000 shares, vesting 250 shares per year. In 2016, the second grant doesn't vest. The original grant from 2015 reduced the limit by only $37,500, so there is still $62,500 left that year. In 2017, 2018, and 2019, the 250 shares reduces the limit by an additional $6,250 of value, but there is still leftovers. We get that $6,250 value by multiplying the 250 shares vesting from the second grant by the grant date fair market value of $25. You can see why working in dollars instead of shares for the 100,000 limit helps to see the overall effect of that $100,000 limit. The different awards have a different grant date, but because they have the same vesting dates, they all feed into one 100,000 limitation. Let's say now in 2017, let's say that in 2020, the person received a 100% vested ISO for 5,000 shares at $30. Since it's 100% vested, the whole value is taken against the limit in that year. But whoa, when we calculate, the value is 150,000 vesting in the new 2020 grant, and we only have $250 left.
All right.
Now let's say that same employee receives a new fully vested grant in 2020 for 5,000 shares when the fair market value is 30. We go back to the chart, and in 2020, the original grant from 2015 is fully vested. However, there is a value from the 2016 grant vesting in 2020 with a value of $62.50. The value of the new grant received in 2020 is $150,000, and for 2020, we only have $93,750 left of the 100,000 value. So fair market value gives us only 3,125 shares of the new 5,000 share grant that can be considered as ISO in that year. So the rest of that grant, 1,875 of the new 5,000 share grant, has to be non-qualified stock option treatment. Or the company could have the 1,875 shares vest the following year in 2021 to keep the ISO status. So to review the preferential tax treatment afforded under Code Sections 421 and 422 for qualified or statutory stock plans, which is what incentive stock options are, as opposed to non-qualified or non-statutory plans. There is no ordinary income for ISOs at the time of exercise, but the spread at exercise is a preference item for AMT, so need to make sure to consider that. If the holding periods are met for an ISO, the gain at disposition at sale is long-term capital gain. If the holding periods are not met, the fair market value at exercise less the grant price is ordinary income. The income is included in the year in which the shares are sold, and there's no FICA or FUTA tax as a result of the treatment under 421 and 422. When you calculate the ordinary income, don't subtract out the commissions before you do the calculation. Those are a separate expense. Also remember that if there is a disqualifying disposition in the same calendar year as the exercise, this cancels out the AMT. You don't have a preference item since you incur income on the spread at exercise, just like a non-qualified option. And here's a nice little chart showing the overlapping of the 1-year and 2-year holding periods. Note that the 2-year holding period is met on 4/16/17, but since the shares were exercised on 5/12/2016, they still need to be held for a year after exercise in order to meet that holding period. So the first opportunity to sell in a qualifying disposition would be after the 1-year holding period, starting from the date of exercise, May 12, 2016 to May 12, 2017. Add 1 day because selling on the 1-year date will result in a disqualifying disposition after all that waiting. Here's our table with tax consequences to be able to illustrate it in a different graphic. The grant price is $10. The price at vesting is $15, but that doesn't mean anything because there's no income at the date of vesting. When the price is $30, the shares are exercised. The gain of $30 less the $10 grant price is not taxable for ordinary income purposes, but that spread is a tax preference item for the AMT calculation for that calendar year. This table assumes that the sale then takes place after the holding periods are met. If the sale is at $50, then the entire $40 spread, $50 less the grant price of $10, is long-term capital gain. The AMT, which has already been paid, however, has to be reclaimed with credits in future tax years, but that's beyond the scope of this discussion. Here's our disqualifying disposition example. Same scenario at exercise with the $20 preference item for alternative minimum tax, but this time the holding periods are not met, so the sale at $50 is divided into 2 pieces of income type. The original spread at exercise, the $20, is now compensation income, just as if it were a non-qualifying stock option. The excess over the value at exercise, the difference between the $30 fair market value at exercise and the $50 sales price, is a short-term capital gain. Lastly, here's another disqualifying disposition. In this case, the ultimate sale price is lower than the price at the exercise date. However, the sale price is still greater than the grant price, so there is some profit. In this case, same $20 spread at exercise is still an AMT preference item, and the holding periods are not met, so it's a disqualifying disposition. However, the sale price is less than the exercise price. In this case, the ordinary income reported as compensation will just be the sale price of $25 less the option cost, or $15. Moving on to non-qualified stock options, which are much simpler than incentive stock options. They don't have to comply with pesky requirements such as limitations on who can receive a grant, such as employees or contractors, the price and term of the option, transferability, and the maximum number of shares available for grant. However, if they are granted at a discount to fair market value, they can be subject to taxes and penalties under Internal Revenue Code 409A, but that doesn't come into play until level 2. Taxation of non-qualified options. Non-qualified options don't have special requirements for buying and holding and are not eligible for special tax benefits. They're taxable at exercise, with the compensation income equal to the spread at the exercise date, which is fair market value less the exercise price. When the shares that have been exercised are sold, there is a capital gain equal to the sale price less fair market value at exercise. The compensation income at the exercise date for non-qualified options is subject to tax withholding if the optionee is an employee. The company reports the income and withholding amounts on Form W-2. For non-employees, the income at the exercise date is reportable on a Form 1099 MISC. When the company reports the compensation income on a W-2, it is entitled to take a tax deduction for that amount. If the company merges with another or is acquired during the life of the option, then the allocation of the company's tax deduction depends on the form of the acquisition. If the granting company survives the acquisition, e.g. as a wholly owned subsidiary, then only that company may take the deduction. However, if the granting company is liquidated and the acquirer survives, then the company that acquired the granting company is entitled to the deduction. Let's go through the specifics of the tax calculation and withholding and reporting procedures. The taxes due consist of the compensation income, known as ordinary income, times the tax rate for the applicable tax. The taxes that are due include federal income tax, FICA, which is Social Security and Medicare, state income tax, disability, and local income taxes where applicable. Remember the supplemental wage rate that we talked about at the beginning. For compensation income over $1 million, the federal supplemental rate is 37%. For under $1 million on an annual basis, it's 22%. Again, the reporting required is a W-2 for employees and 1099 MISC for non-employees. Remember that a sale of the shares previously exercised by the optionee is then subject to capital gains or losses, which is sale price over fair market value at exercise. Let's look at an example of a non-qualified exercise and subsequent sale. The option is granted when the fair market value is $10. When the option vests, the FMV is 15, but there is no compensation income at the vesting date. The option is exercised when the fair market value is 30, so the optionee has a gain, compensation income of $20, which is the fair market value of $30 at the exercise date, less the $10 exercise price. When the shares are subsequently sold, the fair market value is $50. The difference between the $30 fair market value at exercise and the $50 sale is $20, which is a capital gain. The example doesn't indicate how long the shares were held after exercise, but if they were held less than a year, the capital gain would be short-term. If longer than a year, long-term capital gain. Let's move on to IR Code, Internal Revenue Code Section 83, another favorite. This code section refers to the transfer of property, including stock. Generally, income is recognized once property is transferred unless it isn't transferable or if it is subject to a substantial risk of forfeiture, which makes sense because you wouldn't want to recognize income on something that had the potential to be forfeited or that you could lose. There are a bunch of rules regarding what constitutes a substantial risk of forfeiture, but for our purposes, we don't need to go into that. Remember the non-qualified exercise, the last slide? It said that non-qualified exercises have compensation income at exercise, assuming they are not early exercised. This means they are exercised prior to being vested. Sounds like a substantial risk of forfeiture to me. So you have a provision in your plan that allows someone to exercise all their options up front even though they are not vested. In this case, the compensation income would occur at the vesting point, each vesting point. So if someone was granted a non-qualified option for 4,000 shares with a grant price of $1 and exercised all of them up front when the price was $1 and they were vesting annually over 4 years, and the first vesting of 1,000 shares, the price was $4, the employee would have $4,000 of income at that vesting point. The next vesting point, the price is $6, now $6,000 of income. Not a good scenario. Naturally, the employee would want to be taxed at exercise because when he exercised, he had no spread. His exercise price was $1 and fair market value was $1. So he can accomplish this feat by filling out an 83B election form. This allows the employee to recognize compensation income at exercise. The same can be true for ISOs. If your plan allows for early exercise, your ISO will incur potential AMT income as it vests, and if the price is increasing, so is the AMT. Exercise that option when you walk in the door at $1, file that 83B election timely, and voila, no AMT. The only catch with the 83B election is that the form has to be filed with the IRS within 30 days of the exercise. Postmark date constitutes the filing date. You can find samples of the form all over the internet, but you don't even need a form. You can just put 83B election on a piece of paper, and as long as you have the information in these bullets on the piece of paper, you're good to go. Okay, let's move on to section 423, employee stock purchase plans. Requirements state that the plan has to document who is eligible and the total number of shares authorized for issuance. Shareholder approval is necessary. For the most part, all employees must be eligible to participate, and with some exceptions as noted here on the slide. The price can't be lower than 85% of the fair market value at the date of enrollment or the date of purchase, whichever is lower. An ESPP that is qualified under section 423 can't have an offering period longer than 27 months unless the purchase price is based solely on the ending fair market value. ESPPs are non-transferable, and there is an IRS limitation of $25,000 on the value of stock that can be purchased in a year. So let's look at the $25,000 calculation. And you might be thinking there's some similarity in the 100,000 limitation that we talked about for ISOs, and it's always good to remember both of those are qualified plans under the IRS, and both of them have a limitation. $25,000 limitation is calculated by dividing 25,000 by the fair market value on the enrollment date, and that equals the number of shares that may be purchased under a section 423 plan in any given year. And similar to the ISO 100,000 limitation, it's important to remember that for ESPP, the 25,000 must be divided by fair market value on the enrollment date and not any other date. So let's look at the tax treatment of section 423 plans. There's no income at the date of enrollment or purchase. The compensation income is realized at the date of sale. Again, we have a holding period for long-term gains. 2 years must elapse from the enrollment date and 1 year from the date of purchase in order to have a qualifying disposition. The tax treatment of disqualifying and qualifying dispositions is a little tricky though. In a disqualifying disposition, the compensation income that is reportable on the W-2 is the spread at purchase. Since this income isn't reportable until a sale is done, it can be confusing if the purchase price was, say, $5 based on the enrollment date FMV, the purchase date fair market value was $25, and the sale was at $15. Logic would say that the compensation income was $15 less the $5 cost, but the rule is that the spread at the date of purchase is the compensation. So in this example, the compensation income would be $20, 25 purchase date fair market value less $5 purchase price. But the employee only sold at 15. The difference between the purchase date value of 25 and the sale price is either a capital gain or a loss. In this case, it's a loss of $10. For a qualifying disposition, the compensation income is the discount at the enrollment date FMV or the actual gain, whichever is lower. This is again reportable on the W-2. Any additional profit is capital gain. Now we look at the company responsibilities for Section 423 ESPP. At the purchase date, the company has an obligation to do informational reporting on Form 3922, which is required under Section 6039. For a disqualifying disposition that does not meet the holding periods that were discussed, the company has reporting obligations for the income element on Form W-2 and would receive a tax deduction for the amount included on Form W-2. On a qualifying disposition, sale of shares purchased under ESPP, there will always be an element of compensation income, so the company has an obligation to report the compensation element on Form W-2, but the company does not receive a tax deduction even for the amounts included as income on the W-2. Not all ESPPs are designed to qualify under Section 423. Non-qualified ESPPs, similar to non-qualified options, have much more design flexibility. They can, for example, be offered to non-employees or offer a discount of more than 15%. For these ESPPs, the taxation is similar to the taxation of non-qualified options. The participant owes ordinary income on the discount on the purchase date. Then when the participant sells the shares, the difference between the purchase date fair market value and the sale price is capital gain or loss. The company can take a tax deduction for the amount the employee must claim as ordinary income and has been reported in the W-2. I know you've read some about Tax Code Section 409A, which governs deferred compensation as you've studied for Level 1. You aren't tested on it until Level 2, but I want to address at least one 409A related topic here. In most cases, purchase price discounts on stock options lead to taxes and penalties under Section 409A. But there's one exception for purchases that occur on a set date. Since non-qualified ESPPs have set offering periods, just like Section 423 ESPPs, they comply with Section 409A. Let's talk about restricted stock. Restricted stock are awards that are actually issued upfront to the employee, so they are actual shares. Restricted stock awards are exempt from the requirements of 409A. The requirements of 409A apply to deferred compensation. Restricted stock units, on the other hand, are not shares yet. When the units vest, shares are delivered. Restricted stock units are subject to Section 409A, so they can have a fixed payout date or can have the payout deferred, providing there is a valid deferral election on the part of the employee. The company is required to withhold applicable taxes upon vesting for restricted stock awards, or at delivery for restricted stock units. The company reports on Form W-2 for employees and on Form 1099 MISC for non-employees. The company does get a tax deduction for the reported income. So the employee recognizes compensation income at the vesting date equal to the fair market value on the vesting date, less any amount that the employee paid for the stock, which may be minimal, like par value. For RSAs, restricted stock awards, employees may file a Section 83B election, similar to what we talked about before, to accelerate the compensation income to the grant date. This election is not available for RSUs, but RSUs, restricted stock units, have a different feature. The plan may permit employees to elect to defer the payout and therefore the income beyond the vesting date. But the election has to comply with the Section 409A rules. And even though the income recognition is deferred, it's only deferred for federal income tax purposes. FICA is still due at the vesting date. If the employee makes an 83B election and accelerates the point of income and taxation, there is no refund if the stock price drops or if the award is forfeited by the employee. The fair market value at the vesting date that is used for compensation income becomes the employee's cost basis, so when the shares are subsequently sold, any proceeds over what have already been included as compensation income are capital gains. The holding period for long-term capital gains starts when compensation income is recognized for federal tax purposes, which is typically at the date of vesting. And again, the company must report and withhold taxes on compensation income. So the employer's tax considerations. The employer gets a tax deduction, which is generally equal to the income that's reportable on the employee's Form W-2 or on the non-employee 1099 MISC reporting. And for a non-qualified stock options, that would be equal to the spread at exercise for an option that is exercised in line with the regular vesting schedule, or for an unvested exercise, meaning an early exercise, it's equal to the spread at vest or at exercise if the employee filed an 83B election, as we discussed earlier. For restricted stock, and the employee has not elected to make an 83B election, then the employer's tax deduction is equal to the spread at the date of vesting. If the employee has made an 83B election, then the employer's tax deduction is equal to the spread at the date of grant or the date of purchase. Continuing on, for ISOs, the employer will receive a tax deduction for an ISO disqualifying disposition conditioned upon proper reporting into the employee's W-2. For a disqualifying disposition, the deduction equal to the lesser of the spread at exercise, the spread at vest, if the option was, Pam, I'm sorry, I'm losing the room. Can I call you right back? So continuing on and looking at the employer's tax deduction for ISOs, the deduction for a disqualifying disposition is conditioned on the employer properly reporting the compensation income in the W-2. For a disqualifying disposition, the income is equal to the lesser of the spread at exercise or the spread at vest if the option was early exercised, or the actual gain on sale. For a qualifying disposition of ISO shares, the employer does not receive a tax deduction. For ESPP, similarly, the employer deduction is conditioned upon proper reporting, and the deduction the employer would receive for a disqualifying disposition is equal to the spread at the date of purchase, the ordinary income, and the employer does not receive a tax deduction for a qualifying disposition of ESPP shares. We mentioned Section 6039, that the employer has informational reporting requirements under Section 6039, which requires companies to do several things. One, provide optionees and ESPP participants with information that should be helpful in determining their taxes, and two, provide the IRS with the same information. The reports are required after, one, the corporation issues shares to an individual who exercises an ISO, or two, transfers legal title of shares of stock acquired at a discount under an ESPP. The regulations apply to both private and public corporations, although relatively few private corporations have ESPPs. The ESPP first transfer is a transfer of legal title to a recognized broker or financial institution immediately following the exercise of an option, is treated as the first transfer of legal title for purposes of Section 6039, and thus requires that the return and information statements be satisfied under Section 6039. By contrast, the issuance of a stock certificate directly to an employee, or the registration of stock ownership on the employer's books and the holding of shares in book entry form, is not considered the transfer of legal title of stock acquired by the employee, and no return or information statement is required to be filed or furnished until later when legal transfer occurs. Statements to participants. Companies must provide statements to persons who exercised ISOs or bought shares under an ESPP regarding number of shares purchased, purchase or exercise price, and value of the shares transferred, among other specifics. Let's move on to some of the special circumstances that we touched on earlier. So death is one of those. For ISOs that are exercised after the employee's death, the estate receives a stepped-up basis in stock equal to the exercise price and fair value of the option at the date of death. Of course, that pesky AMT that we talked about when ISOs are exercised, that may still apply. Other special circumstances include leaves of absence. In the case of a leave of absence, the regulations provide that the employment relationship will terminate for purposes of the option after 3 months of leave, unless the individual has the right to continued employment with the company under either contract or statute, e.g. under the Family and Medical Leave Act or Uniformed Services Employment and Reemployment Act of 1994. Accordingly, persons whose employment with the company is terminated will be able to exercise ISOs only for a limited period of time. If the employee dies, the Internal Revenue Code places no time limit on exercise by the estate other than the option's existing expiration date. For ESPP participation, the employee retains the right to participate in the ESPP as long as the leave isn't longer than 3 months or the ability to work is guaranteed. However, from a practical standpoint, if the leave is unpaid, there won't be any payroll deductions to participate in ESPP during the leave.
Thank you so much for that, Andrea. I know this is a big section of level 1, and that is a really great overview of what kinds of information the candidates need to know going into it. So for candidates who are interested in additional courses that may help with your exam preparation, we have listed a couple options on this slide. We're providing this exam overview webinar to assist you in your exam preparation, but the webinar in and of itself is not sufficient preparation for the exam. All of our test questions are developed exclusively from the CEP assigned reading materials, and you should study those materials thoroughly. And if you've got a question about what you do in practice versus what you're seeing in a question, defer to the books. We write the questions based on the books. We assess the questions based on what's in the books. This webinar and the others covering other topics at all exam levels are available to you for unlimited viewing until the exam date, as are the entire spectrum of exam prep webinars, as well as one covering study skills. So good luck on the exam, everyone, and thank you, Andrea.